Mary, why don't you go ahead and kick off the intro for us?
Okay, so welcome back, Brad. We're happy to have you again. And for those of you who missed him last time, Brad Pineault is the Vice President of Capital Markets Strategy for Funds Network and FI Product at Fidelity Institutional. And in this role, Brad is responsible for formulating and communicating Fidelity's capital market view to FI's clients in the intermediary channel. So happy to have you again, Brad.
Thanks, Mary. Yeah, it's great to be here. Thank you very much.
Thanks, Brad. All right, so yeah, we'll kick it off. I mean, right now the markets have been crazy. I'm sure I get a phone call every other day wondering, what's going on. Obviously it's very difficult to unpack all the conversation around tariffs, interest rates. Is the world going to implode? So today, Brad, love to, get your guys' thoughts, broad strokes on, what's going on with the market, now, obviously after the initial run up and, some of the pullback.
Yeah, no, it's a great place to start. And what I would say is there's four things to me that's affecting this market. And some of these, ladies and gentlemen, may be very obvious. I'm actually going to end with the obvious one, that being the uncertainty of the new administration's policies. And I'm not just ending with it to save the best for last. I'm ending with it because we at Fidelity believe that catalyst is really just the new kid on the block, right? There's a few other things that have been going on that are driving this market volatility. And of course, today's a good day, but yesterday wasn't. Last Friday was an amazing day. Last Thursday wasn't, right? And that's how this market typically works, right? When you have these unknown variables, market tends to be not only downside volatile, but also upside. And like I said, we don't mind the upside, but volatility is certainly something we believe would become much more prevalent, much more omnipresent. So let me say the four, and I'll be really brief here, Carl, and we can unpack these. And I will also say this before I even say these. I just believe, and I've been at Fidelity 27 years. I've been a strategist for about a decade, and all that means is, we continually look at the market, and we try to think about what's driving it, right? So, right to your question, Carl. So, I think of this idea of let's stay curious, right? I mean, if you have money in a financial asset, we should be curious as to why that company is doing well or why it's not, or why that particular asset's doing well or why it's not. And I understand, right? Sometimes we don't know the answers to that, but even a simple Google search, right, doesn't hurt sometimes just to understand how this stuff works out. So here are the four. Number one, coming into this year, the markets had done so well. Last year, we were up 25% on the S&P 500. The year prior, we were up 25% on the S&P 500. 2022 was a black and blue mark for the market, as we know, right? Equities were down 18, bonds were down about 18. It was a really yucky year. But 2021, you were up 28%. 2020, you were up 20. 2019, you're up 32. You can't make this stuff up, right? The market has been on an absolute tear. And as a result of that, I would say two things. Number one, people's emotions have actually been pretty good. They made some money, whatever that number is, right? For some people, it's $1 million. For others, it's 100,000, right? But you have a pretty good number there, and you don't want to lose it. So these pullbacks that we're seeing, to us, is just a reversal of sentiment. A month ago, people were really bullish and really excited about their portfolios. And literally within 30 days, we've seen an absolute reversal and people have freaked out. And I believe what we're seeing here is just the psychology of losing money. They don't want 5% loss or 10% to be 30. Right. And certainly I don't neither. But that's where I feel like people are fearing. And this market obviously is getting some downside momentum. But Carl, consider this. We talk a lot about multiples, price to earnings ratios. The PE ratio coming into this year was 22 forward. Now, for those of you who don't even know what these ratios are, that's an arbitrary number. What does it even mean? Well, let me say this. In 100 years, we've only been at this level of valuation three other times in 100 years, right? Again, can't make that stuff up. What that basically is telling us is the stock market's value is trading at a multiple or a ratio, right, of 22 times its forward earnings. And don't forget, stock market is nothing more than a representation, an emblematic reflection of the profits of those 500 companies. If those companies are going to be more profitable, that stock market's going to go up. And what I'm saying to you is the stock market price was punching above its earnings weight, right? And that's not necessarily like a red stop sign, but it does tell us to proceed with caution. And what it also tells us is that the probability of any pullbacks and the magnitude of those pullbacks for whatever reason, right, could be trade, could be anything really, is going to probably be much more significant. And that's exactly what we're seeing. So we were still saying, hey, it's still a good time to invest, but just be cognizant that this market is punching above its fundamental weight, and you probably will see some type of pullback. Number two and number three go hand in hand.
I have a quick question for you there, Brad.
Sure.
Do you think any of the concentration risk, though, creates even more velocity to the downside? Because you're starting to see some of the big techs kind of roll over, from a standpoint there. So how do you guys mark that into the equation?
Yes. So I would tell you that is part of the story, but it's not the entire story, right? So if you look at tech's down about 9% on the year, discretionary, right, where Tesla sits, discretionary is down 14% on the year. And some of these other sectors are positive, right? Staples, for example, financials just barely. But clearly, those Mag 7 names are now the Lag 7. That doesn't mean they can't eventually become magnificent again, but for right now, they are lagging. And because of their size, they are pulling down the market. And I would also say, Carl, not just because of their size, but because of the level of ownership. I mean, let's be fair. When those companies do so well, they become, as we've typically seen over years and years, they become the darlings of the ball, right? I mean, everybody wants to dance with these names. I mean, who wouldn't? They've done so well, Carl. So, get me some of that, please. And they were overowned and they were overvalued. Now, that's not to say the fundamentals were bad. It's just like anything else. The prices kind of got ahead of themselves. So in some ways, we're just seeing a more fairly valued set of names. So we still like large cap growth. We still like technology, but we just have to be aware that, sometimes these have to have a reset button. The good news is we don't believe those were in a bubble. So this is not a bubble popping, right? This is not 2000. So I could say that genuinely and sincerely, that is not what we're seeing here. We're just seeing the market, right? And the market from time to time will give you a little bit of a pullback. And I actually see this as a springboard for a more durable rally going forward. That rally might not happen until later this year or maybe 26. I don't know. But a rally will happen nonetheless. I can tell you it always has.
And maybe I'm stealing your thunder. I was going to ask, what are some of those catalysts? But yeah, I'll let you go through.
Yeah, well, I'll tell you. So to me, so here's a couple other things. Let me be very transparent when I say this. The last couple of years, the economy was on fire, like in a good way, right? Yeah. The economy was very buoyant, very strong, very durable on the backs of, let's just say, consumers be consuming, right? The propensity to consume has been alive and well. And we still believe that happens this year. But let me just say, last year, there's this predisposed notion that even though the economy was, firing on multiple cylinders, people still thought that we were in a recession. And obviously they don't know the meaning of recession because we were the total opposite of recession. So anytime that word recession comes up, people are just already predisposed to the notion. So it must be, right, a foregone conclusion. We will have a recession. And there's no word scarier that evokes fear, more recession in this business. And I can tell you this, we don't see a recession. I'll be fair to say we see a deceleration, we see a growth scare, we see consumers and corporations pulling back, but this is not an unraveling of the economy. That's not what we're seeing here. And then one last point is the Fed. The Fed's going to meet today. They're meeting now, right? They'll talk to us at 2 o'clock. They're not going to cut rates today, right? We don't believe, but they'll tell us a bunch of things. I can tell you what I think they're going to tell us, but this is important. The Fed seems to be a bit stubborn. But that's what they should be, right? To me, they are employing patience
Yeah.
over panic. And that's what you'd want your central bank, the world's biggest central bank, right? That's what you'd want them to do. You don't want them to jump to a conclusion just because the market's down. That's not their mandate. Their mandate is to look at labor markets and inflation. And if labor is cracking, they'll cut rates. If inflation is going up too quickly, they might hike rates or they'll sit on their hands. I suspect they're going to sit on their hands until they have more data. But why do I bring this up? Because Carl, the market was trading the S&P at about 5,200 last August, not that long ago, right? Just 7 months ago. I mean, again, you can't make that up. Like, really? 5,200 just last August? Yes. And why did it go up almost 1,000 points, right? It got to 61.44. Like, why did it go up that much? It went up because the Trump rally was part of it, but that actually wasn't the whole story. To me, it's because the Fed was cutting rates, right? And investors, for whatever reason, want zero interest rates back. And I get it, right? Everybody wants to lease the new car. Somebody wants to buy a house and get a 2.75 mortgage. You know, I get it. But you don't really want zero interest rates, right? Your bonds are going to be worth nothing, right? You're no more money market cash. The idea is rates at 450 are very healthy for an economy, but that's lost in translation. So the fact that the Fed's hit the old pause button, I believe that is rattling the markets in a really significant way. Let me be brief here. You ask about, well, Brad, when could we get some footing here? Okay, I would tell you three things. Back to those valuations. Valuations have to come in a bit, right? That multiple probably has to get to under 20, maybe in the 19s. What that basically means is you have to see stocks have a bit more pain here. I wish I didn't have to say that, but I do believe it's like anything else. Eventually, people are going to get back in the public swimming pool, right? And it's not now. I don't believe this is the significant buying opportunity. I feel like the market's probably going to come down a bit more, but eventually we will get there. Another point here is,
How
are
would you
we in a
quantify
recession?
that?
How
Like,
would I
I think
quantify
for
it?
the folks, yeah, just, we talking, we think from a valuation standpoint, the market needs to drop like 5%, 10%.
Yes.
How are you guys project?
Okay. In any given year, regardless of the why, what happens is stocks drop about 14 to 15% within the year. So with any given year, I'm not talking about calendar year, right? 75% of the time we have positive returns in the market going back about 100 years. So I like those odds, right? But within the year, stocks go down about 15%. So Carl, if this is just a typical year, forget like why things are happening. If this is just a typical year, stocks should go down about 15% on average. So if let's just say 6,000 to keep the math pretty simple, if 6,000 was your number, 15% is 900 points. So that gets you to a level of about 5,100 on the S&P, which is basically where we were in early August, right? I mean, a little under, which yeah, again, nobody wants to go down to 5,100, but that to me, and it could go down more. I don't know. Obviously, I wish I did. But to me, that 52, 5,100, that would be a really viable buying point for the market. And even if it was to go down a bit more, to us, if you're dollar cost averaging, and I always have to be mindful. I am very aware that not everyone listening to me right now has a pile of cash just sitting there, that they can invest. We can only be so lucky. So you're probably fully invested. And if you are, how I would be thinking of things is number one, don't be rash with your decision, right? At least talk to Carl first, right? Talk to Mary. I mean, really staying the course has proven since I've been at Fidelity since 1997 to be the very best strategy. Like, just don't do anything, right? Don't look at your account. We always joke. Well, we don't joke, but we do at Fidelity. I work with so many people who've been doing this forever, and they'll just say, well, today is the day not to check your personal account, right? They'll, like, yeah, I'm not checking that one. But I'll be honest, I do check when the market's up 2 or 3% because we're human. But when it's down, do yourself a favor, don't even look at it because it will just make you, pretty upset. But dollar cost average in, if you're saving regularly, these are the days you're just buying more shares, right? Dollar cost average in, stay disciplined, stay patient. This too shall pass. So that's how I would quantify it, is that average of about 15% down, if you were looking for a viable entry point, Carl.
That's really helpful.
Let me talk quickly about the administration. Uh, I want to be so this is not a partisan comment, but we have to be, right, very humble when we say we know we don't know what this administration is going to do. Heck, they don't know what they're going to do. They know what they want to do. They have these big, big plans, of which some of it I certainly agree with. I mean, who doesn't want smaller government? But we don't want to see, thousands, if not hundreds of thousands of people just losing their jobs abruptly. So, let's be fair and balanced here that these are very precarious and somewhat slippery times. But I just want to think about this administration in a multivariate manner in totality. And what I mean by that is, and for those of you who've been around the DC area for a while, right, or this tri-state region, you know that there's spinach versus candy. And right now, this administration is literally spoon feeding, or maybe not spoon feeding, but they're shoving spinach in our mouths. And what I really mean by that is this is all the cost and the uncertainty and the unknown in a very unconventional and maybe a slightly imperialistic manner. For those of you Democrats are saying, no, no, Brad, there's no slightness here. But we'll see, right? Again, I'm staying very nonpartisan. Here's my point. There is candy coming, and it's not an option, right? We will see an extension of the Tax Cuts and Jobs Act. It's not this is not something that they have a choice on. They need to extend that sunset because if they don't, we'll have a pretty significant fiscal cliff on our hands. Very much unlike Trump 45, where he started with the candy, obviously with the TCJA, and then he led with the spinach afterwards, or we followed in 2018. And remember, 2018, the market was down 20% in that fourth quarter because of tariffs, but also because the Fed was, kept tightening rates. But I just bring this up because we will eventually see some type of offset, some type of accretion to growth with who knows, maybe some sizable tax cuts, as well as some deregulatory initiatives. That right now is not even showing up in the calculus when it comes to the Trump administration. It's all bad. It's all costly. It's all spinach. I certainly could appreciate that. But we should never invest with just a univariate right lens. We should be thinking about what else could incorporate here that could provide some substance to the market. And I do believe it's the fiscal side of this regime, which we'll hear more about. And who knows, maybe this is a fourth quarter story, right? Just given the unknown certainty in the House, they don't have a lot of wiggle room. So I understand that, but I do believe that they will eventually come together after plenty of brinksmanship, and that's something we should be thinking of here.
Yeah, I mean, it would be advantageous for them to push that into next year, right? You have a little bit of pain in the first year, and then with midterms coming around the second year, right? You push forward with the deregulation and push the market. With this administration, I mean, you think about the tariff strategy. Where could that go wrong? If they keep it on for extenuated period of time, are there certain levels you guys are thinking about? Hey, if we have XYZ with Mexico, Canada, our calculus dramatically changes. So how are you guys, thinking about the tariffs from that perspective? And then what's kind of the worst case? And, as investors, when should we really be thinking about shifting if they go a different route with it? Because as you said, you don't really know what you're going to get from day to day with the administration.
Yeah, so I'll give you the bull case first. To us, the tariffs should be grouped into five buckets. The first bucket seems to be the most likely and logical. In other words, one that has staying power and durability. And that's the tariffs with China. To us, this is just an extension of what we saw in 2018. And remember, ladies and gentlemen, the Biden administration didn't change anything, right? When President Biden was inaugurated for 4 years, they kept those tariffs on an effective rate of 19% on not all goods from China, but certainly a number of goods. Now, as you know, we have 20% more, a 10 and a 10, so we have a 39% effective tariff rate on China. We suspect that goes up more, but there might be some negotiations with their government leadership. We'll see. But I would say that's the one that probably has staying power here. Bucket number two is our friends to the north and south, Canada and Mexico. This is one that, and again, we're paid to have an opinion. I could be dead wrong here, but this is one where we do believe these are non-durable tariffs. And here's why. It's interesting. if you think about this, and I don't have a chart on it, I'm just going to say it, the most important trade route in the entire world, or at least the one where we've seen a significant amount of activity, is with China and Mexico.
Mhm.
Right. So over the past 5 years, the dollar amount of imports from Mexico, or I should say from China into Mexico, so Mexico has imported, right, 6 times, right, or 60%, I should say, not 6 times, 60% more today than they did back in 2020. They import almost $100 billion of goods from China. They only export about $8 billion of goods to China. So they have a trade deficit of about 90 plus billion dollars. That's a pretty significant trade deficit. Our trade deficit with China, as you probably know, is about 260, $270 billion. It's the biggest trade deficit on the planet, of course. But our viewpoint here is this administration is looking to renegotiate the United States Mexican Canadian agreement, the USMCA, which really isn't slated until next year. But maybe that gets pulled forward. We certainly don't have much line of sight on that. But we do believe this opening salvo, the 25% with Mexico and Canada, is a starting point for renegotiation. And let me just be a bit more blunt. It seems like this administration wants these economies, Mexico most importantly, to, if you will, import more goods from the United States as opposed from China. And we'll see if that plays out or not, but that certainly seems to be the objective. I would tell you bucket number 3 and 4 are reciprocal tariffs or sectoral tariffs. Those we don't believe are going to have much bite. They'll have plenty of bark, and we'll know more about that on the 2nd of April. And then the 5th is just your industrial metals, of which most of that is coming from, again, Canada and Mexico. And we believe that's going to be part of that new USMCA, part 2. So to us, the bull case here is that after some volatility and some uncertainty, the bull case is that we do see corporations and mostly businesses continue to spend money. And the tariffs are not all that significant because it's mostly with China. And we're not worried so much about some of our major industries here. That, of course, is something we won't know for at least a few months, if not maybe towards the end of this year. So that's the bull case. And maybe I'll also say this: if we see even a marginal amount of onshoring and reshoring to the United States, let's be frank here. This is not going to be super labor intensive, and this is not going to be about manufacturing shower curtains, right? Or some type of commodity type product, because there's not much innovation there. But this would be an initiative around smart, innovative manufacturing processes where labor is not the key ingredient. It's more machine-based capital. It's more technology. That's important because our comparative advantage is more tech. It is certainly not the cost of labor. So that's how we see that playing out. That could allow for, think about this, Carl. This could allow for greater productivity trends into 2026, which means you could see more profitable companies with less inflation. It almost sounds like a pipe dream, right? Like, is Brad Pineault know what he's talking about? That sounds wild. But that is part of this agenda, is to make manufacturing, right, a significant part, like it used to be, 45, 50 years ago, but make it a bigger part of the overall economic activity GDP equation, and not just rely on our consumer. So we'll see how that plays out. The bear case is this. The bear case is that this falls off the rails real quickly, right? And let's be fair, even if their hearts are in the right place, and I'm not even saying that they are, their minds are having a challenging time trying to convey this. And that's a big challenge. If you are an industrialist, a corporate operator, and you don't know the rules of the game, the challenge here is you may not play it, right? Now, you're not canceling everything, but you might defer. The other point here is, are these tariffs a detractor to growth, assuming that they have staying power? Or are they inflationary? Or is it a combination of the two, where we have more stagflationary, where the economy is decelerating in growth? Maybe it's not a recession, but it's certainly a stagnant economy, and inflation is going higher. I have to tell you, Carl, that is the very worst outcome, right? Worst case scenario, if you want to get right down to it. Why? Because if the economy is falling apart, again, not outright contraction, but now our GDP is like 1% or less, the Fed would want to come to the assistance of the economy, right? If layoffs are starting to happen, it's like a fire engine, right? If there's a fire engine that shows up to a building because there's smoke and maybe some, very nascent flames, the challenge here is if inflation is too high, the Fed, i.e., the fire engine, may not have any water pressure. They may not be able to come to the assistance to stimulate this economy. And that's a pretty unique situation. Stagflation hasn't really happened since the 1970s. And remember, what did the Fed do? Well, they had to choose. Should we cut rates to stimulate the economy and run the risk of inflation going much higher? And by the way, back then it was 15%. So, that was higher enough. Or do we jack rates up, right, to try to kill inflation and run the risk that we kill the economy? Well, Paul Volcker, if that name is familiar to you, he was the Fed chair. He decided the latter. He took rates to 20%, and he gave Ronnie Reagan the worst recession since the Great Depression, right? 50 years in the making. So we don't want to see that. Yeah, stocks have a long way to go down if we have that type of environment. I don't believe we will. I do believe there is a Trump put out there. In other words, this administration could eventually capitulate. I don't believe they're going to capitulate with China, but I do believe their wild card here, if you will, maybe to use a pressure relief valve, will be with Mexico and Canada. That's where you could see the relief. And it certainly allows the administration to say that they've won because they're still looking towards China here, but at the same time, they're not going to drive this economy into a significant and long-lasting recession. I don't, anything can happen, Carl, but I don't see that outcome happening here.
Doesn't the administration effectively have to slow down the economy to get interest rates? I mean, one of the conversation points I always have is just around Social Security, with that running out in, 6, 7 years and the debt payments on that alone, don't we effectively have to get the debt payments down, or figure out a way to one, cut it, or figure out a way to stimulate it, which I mean, BlackRock CEO is talking about, strategies around potentially investing in the S&P or some variation of that.
Yeah, I mean, so the administration has actually been very, very clear when they say they'd like to get interest rates down. And by the way, it's not just the Fed, right? They're talking about yields in the marketplace, right? So treasury yields down so they can service that debt, which I'm sure a lot of we know the national debt is 30 plus trillion dollars. The cost of the outstanding treasury debt has eclipsed $1 trillion per annum. So think about it, that budget, right, that they roll out, $6 trillion or so, 16, 17% of it is just paying debt. Uh, that's not healthy, non-sustainable. So yes, they do want to get rates down for any new debt here, and I would tell you that they do want to get the dollar down a bit, so they can manufacture these goods and they can be cheaper for all of our trading partners, right? So they can import those goods. That seems to be a pretty big initiative. So I'll say this: if that is something they're thinking of, that could help equities. And maybe and I don't have a succinct answer here, but some of the things I'm thinking about is domestic has completely trounced international ever since the sovereign debt crisis that took place in 2010, right after our global financial crisis. So remember, Europe went through a double dip crisis, the global financial one in 2008, and then, 15, 18 short months later, they went through the sovereign debt crisis where, Greece and Italy and Portugal and Spain, they were all living off the very generous credit rating of Germany. That's like you running up your credit cards without any regard, and your neighbor across the street never uses credit, and their FICO is 820 and yours is 500, and you're like, I'm just going to use his credit, That doesn't go well, especially when you're a big old government. My point is this. That didn't do international any favors, right? And then Japan went with negative interest rates in 2016. didn't do any favors. But now we're starting to see some resurgence in Germany and Europe and Japan. And over here, we're dealing with some turmoil. Big reason why equities in the international market are doing very well. I mean, Europe's up 10% year to date, and the S&P is down almost 10%. So that's a 20-point swing. And there's reasons why that's happening. If our dollar continues to weaken and our rates go down, international may outperform here, and not just for 10 weeks.
Yeah, I mean that was one of the segues I was going to ask about because oftentimes I have 401k participants or clients ask why would I invest international? Because you look at the last 10, 15 years, the returns just haven't been there. So you could have been much better suited doing the S&P, but having an allocation there. How do you guys think about that as far as what parts of those markets? I know China's obviously had a pretty substantial run up. I mean, how are you guys thinking maybe about some of the emerging markets or developed markets internationally?
So our thesis has always been we buy companies, not countries, right? So, even though sometimes the country may have lackluster economic growth or activity, or they may have right interest rates that aren't great or earnings aren't great. That doesn't mean that these companies, right? There's a number of companies that can't be exceptional, stocks to own. So I'd say that's first and foremost. You have to be very discreet when buying international. And think about it this way. The S&P 500 is an index of 500 companies that are all based in the United States. They don't all get their revenue, of course, here, right? But they're all based here. They're all under one rule of law. They're all under, right, one Congress for stimulus, right? They're all under monetary authority known as right, obviously the Fed Reserve Bank of the United States. But if you go to Europe, there's 28 distinct countries, right, in the Eurozone. That's really difficult, right? They all have different presidents or prime ministers or chancellors, and they're all kind of beating to their own drum for the most part. And then you throw in Japan. I mean, their culture couldn't be any more different from those of Europeans or even us, but that's also part of the international index. And then if you want to throw in the emerging markets, I mean, some of these are literally third world countries. They might be democracies, but and then others are communists. So how do you just blanket statement, Carl, international versus domestic? It is almost impossible. So what I would say is two things, and I'll be real high level here. Germany just 2 weeks ago, they're trying to rewrite their rule book on how much money they can borrow, and the parliament there has to decide on that. And it looks as if they are going to pass this through, this resolution, which allows Germany to spend more money, and not just on satellites or rockets or missiles, because a lot of it was to increase their defense budget if the U.S. wasn't going to be their best buddy any longer, paraphrasing, of course. But also, they're looking to invest in infrastructure. They're looking to make their bank stronger. They're looking to invest in different ways to generate more alternative energy, right? And not just rely on nat gas, for example, from Russia. So we believe that Germany is turning a significant corner, and the companies that are based there, like domicile there, could look to do a lot better. You could say similarly in Japan, although what's happening in Japan is they're just getting older, right? And you thought immigration was a hot button here. There's no immigration in Japan, right? So when people die, it's really difficult, right, to see a replacement of a worker, for example, because they just don't have enough people. About 140 million people live in Japan, but they are one of the oldest economies, right, on the planet in terms of their average age. Now, why do I bring that up? Well, there's a shortage of labor. And when there's a shortage of labor, wage growth tends to be higher, right? Don't overthink it. If you're an employer in Tokyo and you're looking to hire somebody and there's just not enough qualified applicants, you're going to have to pay up for that, right? Yeah, and that's inflationary. So think about this, right? Japan for 30 years had almost no inflation, right? It was called noflation. And at times it was deflation, right? We actually had negative price growth. That's awful for an economy. That's awful for the stock market, right? Because profits are actually going down if prices are going down if you're a corporation. Well, now they have inflation at 4%. And, that's headline, and core is a little bit less than that. But that actually is welcomed by the central bank and the authorities there. So I'm bringing this up because Japan has been a strong place to be the last year and a half or so, especially Japanese financials. I got to tell you, Carl, we believe that this is a protracted story. Both Japan, which is the fourth largest economy on the planet, and Germany, the third largest economy on the planet, are taking a turn for the better. And we're not weighting those names. I still want to be in domestic, but for clients of yours, maybe, and certainly all my clients that have this big underweight, right, to international because
Yeah,
why
yeah.
why own it? I would reduce the underweight. Yeah, genuinely.
One area that has really struggled has been in the US, maybe in the small cap space. We just have seen, significant underperformance. Do you see that as an area of opportunity as well, with some of the onshoring and lower rates, or are you guys still more favorable to kind of the large companies out there?
So I'm not even going to dance around this one. We believe small caps are a real challenge here, right? They're a real challenge for two big reasons. Number one, when small caps years ago, right? If a company wanted to come to market because they needed to raise capital, of course, a company has two ways to do that. Well, three ways. One, they can borrow at a bank, which, you can't go in there and ask for $100 million or $10 million. And if you did, it would be expensive. The other way is to issue debt capital, which is probably more prudent, right? Especially if you had assets to back it up or some type of intellectual property. And thirdly, you issue stock, right? And you start to dilute your ownership, but you raise capital through equity. Well, years ago, when Microsoft came to market in 1985, right, as a public company, they were a small cap company, right? Amazon, small cap company, right? Back in 1999. These companies are small cap. I mean, look at Uber when they came to market. They were already worth 70 billion. No offense, but that's not small, right? That's very large. So what we're saying is because the private equity market has been pretty good place to be. Some of these exciting companies, if they're looking to raise capital, they're doing it privately, right? So they're not in the index. So what you end up with is maybe companies that are challenging, right? Secondly, and this is just evidence of this, about half of the small cap index is not even profitable. About a third of it has variable debt levers, and it's about 11%, right? So if the Fed's not looking to cut rates significantly anytime soon, small cap companies are probably going to continue to be challenged with more expensive and variable debt, as well as a profit regime that's just not there. I really think of small caps as doing well in a perfect environment where rates are lower and yet the economy is thriving. Right now, there's a big question mark. Is the economy thriving or are we going into a big recession? And it seems like the Fed, as I mentioned, is patient, not panicked. So rates aren't coming down in size anytime soon. So I feel like small caps, every now and then they pop, but
Yep.
I feel like they're a challenge here.
Yeah. So, I mean, from a standpoint of allocation, yeah, it's certainly still considered underweight for you guys.
Correct.
Yeah.
Yep.
And
Less than 10% of a well allocated equity portfolio.
yeah, I think you've certainly hit on the most important part there. I mean, with the amount of called unprofitable companies, active management, certainly in the small cap space and the international space, there's so much more volatility. A lot of folks, when they show these index perform versus active management, they just talk about the S&P 500. They don't go into, the disparity when you get into these small companies or certainly the international side.
Correct. They don't. No, they don't. And the one thing I will say, and you just said it too, I'm calling it discrete diversification. We should put that on a piece of paper somewhere. Discrete diversification. And what that really means is if you want to be in small caps, right, even if it's a small weighting, if you want to be an international, be very discreet, right, and very selective on the constituents you own. Look for an active manager, an active ETF. To be index and certainly might have indices there, which fine to a certain degree, but then you're beholden to just the market cap or depending on how it's weighted. So to be active there, we like to say it's not what you don't own that gets you into trouble, right? Or I should say, it's not what you own that gets you into trouble, it's what you don't own, right? In some ways. So that's really important. You don't have to have all the names in the index. You can not own them, right? And try to find those companies that are profitable, diamonds in the rough, if you will.
That's really helpful. So folks, as we finish up here, I want to give the last couple minutes. If any of you guys want to send in any questions, want to go ahead and take some, open up for questions. So feel free to send into the chat, and then I can go ahead and ask Brad. Of course, I can always do that afterwards if any questions come up. Another area, obviously, we're starting to see is, with the Trump administration, the embracing of the crypto space. How are you guys thinking about the evolution there? Because you're starting to see conversation around whether that can go into 401k plans. I've had a number of folks ask, hey, why can't I have this within my 401k? So how are you guys thinking about that evolution and then incorporating that into just your overall asset allocation? And do you guys see that becoming more widespread?
So yes is the answer. We do see it becoming more widespread. And here's why. To us, there is a significant diversification benefit of implementing cryptocurrency generally, but Bitcoin being the adolescent in the room. I won't even call it an adult. It will get there. But the adolescent here within all these cryptocurrencies, it does give you tremendous upside, but also downside volatility. So if you think about efficient frontier and shock adjusted ratios, the upside's been so significant going back to really 2010. So you get 15 years of data here. I mean, 2008 obviously is when it all started, but 2010 is where we started to see some adoption. Can you imagine Bitcoin back then was literally $30?
Yeah.
Yeah, so it's had a
Would
pretty
be on
good
this
run.
call if we were owning it then.
Well, that's right. And as soon as it went to 100, you sold it because you
Yeah.
just you hit a three bagger.
Yeah.
um, but so I bring this up because to us, Bitcoin is a bit like digital gold, right? You could ask the same question about gold and why is gold doing well? Gold's doing well because of fear, right? Gold's like it's been that asset for millennia that people want to own, right? It has that store of value. But gold's also doing well because there are a number of people increasingly, and maybe for good reason, right, that believe the fiat currency, US dollar, for example, is inflated and probably isn't worth as much as people are thinking it is, right? I mean, let's be honest, right? The dollar is worth what it is because we just believe it to be that way, right? It's backed by the full faith and credit of the United States government, and there's no other safe haven on the planet that touches the U.S. sovereign, characteristics of the United States Treasury, right? The dollar is the world's reserve currency. The Brits thought that as well, right, in the late 19th century until that stamp of approval was basically taken away from them, really in the early 20th century. But let's face it, during the Bretton Woods Marshall Plan era of the mid 1940s, where the U.S. was the only economy that was worth anything, right, in that post World War II environment. So 80 years later, there's questions about the long-term viability given our debt level, given our deficit, maybe the dysfunction of Congress, if you consider Congress, both red and blue, by the way, are like a board of directors, right? And the corporation is the treasury. I actually see it that way. And there is some dysfunction there, right? So the viewpoint here is Bitcoin should continue to get bid up here. Will it be volatile? Double thumbs up, right? Right now, we're just seeing the downside volatility. Today's a decent day, but I suspect this will eventually find its footing. Certainly, once this administration tells us a bit more with succinct voice, the uncertainty starts to abate. Bitcoin's been going to be one of those first asset categories that goes higher, right? Because it's just a representation of risk. And we will have risk on markets, right? Right now, we're just not in that environment. But I can tell you, if you have a series of rainy days, right? And that first sunny day comes around and it's 68 degrees, you, you never want to go indoors, right? it's the same thing with investing, right? If you just can't stand it anymore, that's when you should definitely not look at your account, because that's typically like when you really want to capitulate and sell. That to us is the time you should probably be buying. Just like the great Warren Buffett always says, let's be greedy, like outright greedy when others are fearful, and let's be fearful when others are greedy. We weren't greedy 6 weeks ago, but we certainly weren't fearful. Now I would argue we're getting close to peak fear. So I think we have some and months before we really get to that point. But that's when you'd want to be absolutely greedy, and try to borrow money from your uncle or aunt, if you will, and put it to work. Of course, I'm saying that with a smile, but you get my point. These are buying opportunities.
Yeah, I mean, I had that conversation with a client today, and it was as the news cycle gets worse and worse, that's when you should really be starting to plan to kind of chop at the bit. As I get Bitcoin. I mean, I started getting so many phone calls about allocation when it was at 110,000, and now we're at 80, and they don't want it in the portfolio. So I think it's always important, folks, to remember just one, if you're going to invest in asset classes like that, you have to understand the volatility getting in. So if you're concerned about a 10% drop in the market, you certainly can't invest in Bitcoin because the volatility there is substantially more. So, but at the same time, you also have to think about the overall allocation. Looks like we have one question here. Do you have any specific recommendations in the international equity space, equity investments as far as like Germany, Japan, maybe any companies that you guys would think
I
of?
so I unfortunately I can't talk too much about that. But what I would say is if you buy a diversified international fund, the one I'd be looking at is something that is benchmarked to the ACWI ex-US, which stands for All Country World Index ex-United States. So that's going to have about 70% developed market. So think most of Europe, certainly most of Asia, like notably Japan and Australia. But then it is going to have 30% in emerging. So you'll have some China, China's the biggest, but you'll have some India, you'll have some Brazil, right? You'll have South Korea, you'll have some other areas as well. That's the type of fund or ETF I'd be buying, right? It's broad based, buy something active, right? These active managers, I mean, some of our funds that are in that space, they're up 10%. And, they've been doing this for 30 years in some cases. And, they've just said that, hey, consider the environment, right? Like I've said, ever since 2010, nobody's wanted to buy international. And then tech took off like a moonshot. So you had kind of the best of both worlds going for domestic and the worst of both worlds going against international. And one last thing I'll say, I started with this. The multiple in the S&P coming into 2025 was 22 forward. The multiple in Europe and in Japan at the same time was 14 forward. Now, I'm not saying that will get to 22 or we're going to get to 14 because their earnings growth typically is not as strong as ours, right? We have much more capital light. Um, it's
Tax
just different
advantages.
ways. Exactly. The tech component is 7% of the index over there. It's 30% here. So those numbers shouldn't be apples to apples, but I'm just bringing it up because those companies were cheap, right? International. They were left for dead. And now people are thinking, I can tell you right now, people are still thinking, it's a head fake. Yeah, I'm not, I'll just let that do what it's going to do. I'm not so certain. To me, I feel like Germany is going to have growth like we haven't seen since November 9th of 89. That's a specific date, Carl. I know you know that date. That's the date that the Berlin Wall fell. And we saw East and West Germany reunified, and talk about an auspicious beginning for Germany. And it was, right? The 90s were a good time for that country. And then, of course, China kind of displaced everything. But I just bring this up because I feel like Germany is turning a corner, new leadership, rewriting the rule book, as I've said. Japan, they seem to be rewriting the corner. We'll see. But we're seeing a lot of signposts that tell us that international, could lead, or at the bare minimum, will participate in market rallies as we see them going forward. So, yeah, that's how I think about it.
Well, guys, I mean, that's why Fidelity is here. They certainly manage a wonderful international sleeve, so they can certainly be a resource there. I guess last question I'll have for you, Brad. I've got this a few times, obviously. If the market, are there any things you see that could create a worst case scenario? Because I've had some clients say, hey, I think this market's going to correct 30 or 40%. Based on our conversation today, obviously Fidelity, that's not your base case in, any realm. But are there any telltale signs that may make you rethink that?
Yeah, not my base case, not even my risk case, but I'll give you just an easy one to digest. And it happens to be that stagflationary argument, right? So if these tariffs are durable, most notably Mexico and China, if Trump doesn't capitulate and he keeps these there for the entirety of 25, what we will see is we will see a detraction to growth, right? So GDP will go down. I still am not calling for a recession. I could be convinced maybe, but I still believe that we will have, even a modicum of economic activity. But the inflation one is the issue, right? Remember, we're still above the Fed's target of 2.0. And if you look at core CPI, for example, core CPI is at 3.2%. If that goes to the mid threes or high threes all of a sudden, the Fed, again, doesn't have to act, i.e., how they usually would act is like 2022, right? They would tighten interest rates to try uh, to make borrowing more expensive and you spend less money. And obviously, the price level of goods and services comes back down. But if they just sit on their hands while we see labor start to erode, by the way, we didn't see labor erode in 2022. It actually remained very strong, hence why we had no recession. The last recession we had was 2020. But if all of a sudden you start to see layoffs and these knockoff effects create more layoffs, not just government, but companies that aren't even based out in this area, uh, that's where the Fed needs to act, but they can't. And I got to tell you, the media is going to magnify that to the nth degree to suggest that there's a fire truck sitting out your building's on fire, but there's no fire hydrant, there's no water pressure, they can't do anything. They're like, I can't help you. I'm sorry. No, but you need to help me. This building's burnt. I can't. I just can't do it. That would be the very worst case scenario. Yeah, and stocks would be down 30. I don't know. I don't know what they'd be down, but they'd be down.
Yeah.
But let me say this, okay? Because I always get to end rationally, and this is not my ignorance here. I want to be rationally optimistic, ladies and gentlemen. But let me say this: in that scenario, what's the cure for higher prices? Higher prices is the cure for higher prices, right? In other words, you will eventually see an organic amount of, let's just say, consumers saying, I'm just not going to pay the higher price, right? And I'm going to forego it. I'm not going to go on that vacation. I'm not going to buy that automobile. Heck, I'm not going to buy the filet mignon. I'm not going to buy the organic food, even though I love organic food, right? Whatever. You're going to see these decisions. I mean, we are consumers, right? So we don't have to do certain things. When that happens, right, just like anything else, you're going to get to a point where inflation is going to come back down and the Fed's going to say, okay, I got the water pressure now. Let's go ahead. Remember, they're at 4.5% Fed funds. In other words, they're not at 50 basis points. They have plenty of dry powder, plenty of water when they want to use it if they have the pressure, right? They can stimulate this economy. And if the market were to drop 30, stay the course, ladies and gentlemen, because it's going to go up, right? It's going to reaccelerate, and you're going to want to hold on to both horns of this bull, right? That's how I see this playing out. So, like I've said, at the light at the end of the tunnel, it's typically a really good time to be an investor. One last thing here, Carl, not that I need to say this, but remember COVID? We had no idea. We were walking around blindfolded, like we don't even know what this virus is and how we catch it and all this stuff. Market was down 33% in 5 weeks. The market peaked on February 20th, 2020 to 2020. Remember that? And then it bottomed, at least in that cycle, on 3/23/20. It was a Monday. And if you just stayed the course, the market was up 60% for the rest of the year, and you finished up about 19. Now, if you sold at any point in time, you probably have a ton of remorse, right? And I hear it all the time. Best thing you could do is nothing. The next best thing you can do is work with Carl, work with the team, and say, hey, how can I shore up my allocation here? Maybe I want to generate more cash so I can sleep better at night, right? All those things. But that's obviously case by case, very unique and custom solution for anybody listening in.
Yeah, I mean, I think hit the nail on the head. I mean, the reality is the market is only was only down 4% coming in today. But if you turn on the television, you would have think we've seen a 20 or 30% correction. So I think it's really important to remember this volatility is very normal in the course of the year, and ultimately is going to provide an opportunity. I mean, Brad hit home here, hit a home run with just talking about the opportunity for the Fed and the government to actually provide additional opportunities for the market to run up into next year. We do expect a lot of volatility over the next couple of months as we do deal with tariffs and a lot of the negotiations and back and forth out of Washington. But don't allow that to get you out of your overall strategy. We're here to be a resource for you guys, whether it's just reviewing your 401k or reviewing your outside portfolios, certainly lean on us. We also have resources such as Fidelity. I'm going to continue to be offering these education series for you guys. So feel free to tune in for the future ones. Brad, thanks as always. Always a pleasure chatting with you. And thanks everybody for joining today. Much appreciated, and hope everyone has a wonderful afternoon.
So, Carl, my last question for you is I love the coffee with Carl, but I'm wondering when we're going to do cocktails with Carl. That's the question
I think that would be a little more catchy. That might have to be the new series for next year. So with that, guys, hopefully I'll have a new edition at some point in the future. And thanks, and have a wonderful afternoon. Appreciate it, Brad.
All the best. Take care.
Appreciate it. Thank you.